Hello and welcome to another edition of Nucleus Investment Insights. Apologies for the late start today. We're just going through a few of the latest releases of economic data. It's been a busy morning. One of the things that did come out is US inflation, and I thought it was well worth having a bit of a run through. First of all, a bit of a look at where we're sitting in terms of US inflation, in terms of some of the big picture sort of, I guess, changes that we've been seeing over the last years and even decades. And then secondly, I thought it was worth having how that fits, worth having another look at in terms of how that fits into the overall investment picture and where that sort of sits in terms of that. So just a quick reminder, everything you hear today is general in nature. None of it is personal advice. So, if you do want to have personal advice, you can book in for a call with one of our advisors. And also, if you like this content, hit the like button and smash that subscribe as well. And there's also a notify button so you can get notified when these are coming on. So I'm going to jump into some charts, which I've shown a few times before. And these ones in particular are looking at US inflation broken up into a few different categories, and it's well worth sort of having a sort of looking at this from I'll sort of describe it for anyone listening in just to the podcast, but it sort of breaks it up into a number of different eras. And the first one is the 3, 5, and 10 years up until December 2019. So there's a pre-pandemic, looking at what type of inflation we can see. And I've got the food category up here, and you can see that we basically had deflation or certainly very low inflation in every category, sort of well below 2%. This is in terms of the food at home, and so the actual and it breaks it all up into the fresh fruit and vegetables and all these things like that. And then right at the bottom is the food away from home, so eating out. So you can see that food at home very much ran at this low inflation levels, whereas food away from home was running at sort of 2.6, 2.7% inflation. So considerably above what we're seeing. And that's that idea that you've got services inflation sort of built into that, and the cost of that you're paying over and above that. Then you hit this pandemic era. So I've sort of broken out 2020 just because, lockdowns and all those types of things. And then the 2021, 22, where we really saw that inflation take off. And so you can see those. And then now I'm looking to November 2024, and what's the sort of 3-year, 12-month numbers is this sort of next era. And then finally, we've got sort of the recent months. And I guess the one I'd highlight here is the last 3 months, we've started to see this tick up again in food at home. Now, it's not across every category. There is certainly an effect from eggs, which are seeing quite significant inflation due to avian flu. So that's sort of, we're talking about 40, 50% inflation in that one category. And that does flow on to some other products in terms of, baked goods and other things like that. That sort of it's an input into. But I guess the broader sense from that is, and particularly in the last sort of 3 months or so, fruit and veg is up, eggs are up, and meats are all up in terms of inflation. So something just sort of keep an eye on. And then we've just got that ongoing inflation, which is sort of quite consistently 0.7 to almost 1% higher than what was seen in the past in that food away from home. So that eating out, still running those quite high levels of inflation. So, and just sort of contextually, why am I focused on this? Because it's going to make a big difference. We know Trump's policies are generally going to be pro-inflation, and he's spending a lot of money, and he's putting tariffs and a number of factors on there. And so sort of the idea is he's going to try and run the US economy relatively hot. So it makes a big difference. Last time he came in, the US was facing deflation, and so we had this, and most sort of developed countries, Australia included, were facing this same sort of outlook of deflationary factors, really driving economies and central banks lowering interest rates. And then as Trump steps in and with a bunch of inflationary policies, it helps to offset those. So what I'm looking at here from US inflation is it's the part about saying, if we got to the point where most of the pandemic inflation had sort of faded off, and we continued inflation continued to slide, and it got back down, and we're back to that point about facing deflation, and then Trump steps in with a bunch of inflationary policies, you've got a lot less concern. But if he sort of hits the ground running, so to speak, with an economy that's still sort of facing this inflation numbers coming through, and this latest batch of inflation certainly shows that it's far from gone, then we've got bigger issues. And so the numbers we're looking at just for that total group of food from home, so it's 1.6% for the 12 months, which is fine, great. That's sort of not back to normal, but which is sort of more like 1%, but it's certainly pretty close to it. But the latest 3 months, if you annualize the latest 3 months, we're back up to over 4% in terms of that food at home. And then food away from home is sort of keeps going at sort of 3.5%, basically over the last year, pretty consistently. And that's sort of facing versus sort of 2.7, 2.8 sort of pre-pandemic. So not a lot of signs of, certainly some concerning signs on the food front. On the energy front is looking a lot better. So this is one where Australia, this is one key difference, I think, in terms of what we've been speaking recently about the problems in Australia with higher energy costs. But it's all negative basically. Not only did you have the 10 years up until 2019, it's sort of running at negative energy inflation. For a lot of the last year, it's all been negative energy inflation. You really only saw 21, 22 where we saw that sort of spike, and a lot of that wasn't. The less of that was pandemic driven. A lot of that was Ukraine war and what's happening to Russia, and keeping in mind that these negative inflation figures we're seeing are coming about even without Russia re-entering the global economy. And so if that happens, we quite likely see another flood of energy prices, another flood of energy coming on, and then sort of lower energy prices. Having said that, so while big picture energy isn't that much of a concern, if we're just looking at that electricity, utility, gas services, and energy services for the last 3 months, again, we're actually starting to see that signs of inflation starting to rear their heads again. So probably less of a worry at this point, but just well worth keeping an eye on it. This isn't the type of thing that's going to drive the Fed, but it's going to make things worse if that continues. Then when we look at goods, so going through these 4 sectors again, goods was really where we saw that deflation, just entrenched deflation up until 2019. So that's the 10 years. You're looking at 0% annualized inflation in goods, negative 0.3% over the 5 years. So certainly very deflationary. Over the last year, we're back to deflation. So running at negative 6.7. The last 3 months have ticked up again. A mixture of, it's not completely across the board. There's just a few different categories that have sort of peaked, sort of stepped up. And when you look at the sort of recent months, again, there's sort of nothing there in terms of a trend that would say it's of concern yet. But keeping in mind, this is the sector where we're going to get hit by the tariffs. So there's going to be that short-term hit to these. But then, and then going forward from there, it's probably got some, particularly if these tariffs have been put on China and China's looking at lower currencies and deflation, it's probably a momentary blip before we head back to deflation on this goods front. So that's the good side. Then we jump into services. And this is the area again where we're really looking for these numbers to come down to give the Fed that confidence keep cutting. Now the latest figures, they're not terrible, but they're certainly a little bit higher than you would have wanted at this point. We've been speaking about, so if you again look back that sort of pre up until 2019, you're running relatively high levels of inflation in this part, 2.7 to 3% in terms of the types of the type of inflation you'd get out of services. And then and let me just take that back into that big picture you were talking about before. So we've got services running at that sort of 2.7 to 3%. Then you've got goods running at say 0 to 0.5%. And then you're looking at food sort of running at that sort of similar types of levels, and energy not going anywhere. And that sort of gives you that overall inflation of 2% or less than 2%. And so it's very very different market in terms of, or very different environment depending upon which sector you're looking at. So we're not that concerned if we see inflation in services above 2%. That's pretty typical, but then you need the offset in those other categories to really bring that inflation down. And so here we're looking at inflation levels of it's starting to tick back up on that 3-month annualized figure, back up to 4% again. The 12 months we're at 4.6%. So still running pretty strong on that whole services side, and not really enough to give you that. It's fading away, but not enough to give you the feeling that, look, this is we're definitely on the down path, and that it's all clear for the Fed to start cutting rates. Right now, it's going to be a read for the Fed as to whether they're going to be, there's some question marks over, there'll be question marks and looking at really about the earnings and the wages. Like that's it seems to be a bigger focus for the US rather than Australia. I think if you gave, if Australia and the Reserve Bank had the same sort of focus on wages as what you're seeing in the US, then you might have already seen some possibly some rate cuts, or at least at least a lot of talk about the rate cuts. Whereas Australia seemed to have more of a focus on the underlying levels of inflation than wages. So I'm just going to jump to a quick sales message, and then we'll come back with some more thoughts on this.
We'll be back with the investment insights very shortly. Nucleus Wealth is an active and passive investment manager. If you like what you're hearing and want some help with your investing, we can do it for you via our active portfolios. Our tactical and core portfolios use the insights shared in this podcast to construct and manage your investment. We blend tactical portfolios to offer our combinations of international shares, Australian shares, government bonds, and cash. We vary the asset allocation with the goal of protecting your capital in times of market uncertainty. We also have active international and Australian share portfolios. These are chosen using our quality and value investment philosophy. You can find out more at nucleuswealth.com. Now back to the show.
Right, so the next thing to really look at is what we're seeing out of China. And I've just got a longer term time series here, and it's broken up into a few different elements. The GDP deflator in China, which is, I guess, the more theoretical level and sort of mix. It sort of has a combination of production and consumption within that. And then the two sort of main elements of that, producer prices and then consumer prices. And the key to this is sort of understanding that, look, China has been going through this period of quite high inflation for a long period of time, and of consumer inflation. Producer inflation has come in these big waves of negative for sort of a decade or almost a decade, and then positive for sort of 4 or 5 years, and then back to negative and back to positive. And the producer prices have sort of been into that deflation for the last maybe 3 or 4 years, and still look quite negative in terms of what we're seeing from that front. The difference to some of the episodes in the past was that Chinese inflation on the consumer front was running still at 3, 4, 5% over that time frame, and now it's not. So now, so what we'd see is, even though producer prices would fall, the GDP deflator, which is sort of I guess a broad-based, or I guess a weighted measure of the inflation in China, was still positive. Whereas now we're looking at negative, and it's been negative for a number of years now, and it isn't looking like coming out at the moment. And this is this idea of are we going to get this Japanification in terms of China? Is that just long periods of deflation, and that makes if you've got lots of debt, that makes it harder to repay. So if you think about sort of the company that takes out a loan for $100, and you've got inflation, and they're making, say, profits of whatever, $10, and then you've got inflation running at 5% per annum or 6% per annum, then you've taken out your loan at $100. That's staying where it is, or as you're paying it down, and then you've got your earnings that's started at $10, and then just is going up every year at inflation. So in 10 years' time, all of a sudden you're making 3 or 4 times as much as what you made 10 years earlier, and the debt that you took on is now just such a small level that it's easy to pay off. When you start getting into deflation, though, that goes in reverse. So now I've got my profits start shrinking or going backwards, and so that's that problem we're talking about there. So where does that leave us, and why am I sort of bringing in this China? Is because China has been this source of deflation for the rest of the world, despite the inflation in prices that it's had, because they've been picking up a larger share of global trade, and they've been pushing through those prices. Those prices have been falling, particularly on more discretionary goods, and that was while they had inflation internally. Now we're looking at deflation internally, so they're quite likely to be keep pushing this deflation out in the goods, and now it's a matter of tariffs. And so we've got Europe looking at tariffs. We've got the US promising tariffs, and so it's this question about, well, if China lowers yuan, then they get a whatever 60% tariff from the US. The currency falls by 10% or more, and that sort of helps to offset some of that, but they're still behind. But now that currency's fallen 10%, that's probably falling against a lot of other currencies as well, including, say, a country like Australia. And so now they're trying to export more into Australia, not big enough to take off the stuff what they're missing from the US, and so then they have to push it out to other areas in the world, and potentially have to cut prices to try and sell the goods that they have. And so the question is, as we're the biggest question I guess we're looking at coming out of this is, as Trump comes into power, we've got this inflationary push from in terms of the US. That's going to be met with this deflationary push coming from China. And we've got these sort of two titanic forces coming to it. Where does that leave us in terms of the US? Is the deflation coming out of China enough to offset some of the inflationary gains we're seeing there? Or is that or do we see the US economy overheating, and the Fed really needing to put the brakes on? Because that's the way we're thinking about the Trump presidency and the limits we have, is that Trump loves to push boundaries, and he will tend to keep going. If he pushes something out that's pushed a boundary and he doesn't get enough pushback, he'll probably go again and probably go again. And the limiting factor is probably going to be markets for a lot of these, in that he will pay attention if stock markets start to fall in a considerable way, or if we see sort of bond market turmoil. And so that's where we're trying to focus on and really look at these inflation figures, and just make the point that if we don't see if we don't see the inflation come through, then Trump will sort of keep at these policies until we sort of it's more positive for markets, in that we'll see lots of transfers, I guess, effectively from governments and consumers to corporate profit margins, and we can still see that fundamental growth coming through. If, however, we do see this inflation headed the way we've seen it over the last 3 months, where it's starting to tick up, and then you get the Trump tariffs, and he starts to try to run up the credit card bill as well at the same time, that's where we have concerns for markets. So nothing to sort of panic about just yet, but certainly this is sort of the key part to be watching over the coming sort of 6 to 12 months, in terms of really trying to assess what Trump's going to do to markets, and how much further where's the breaking point for stock markets to just keep rallying and rallying? And for us, it's largely around that. If inflation then manages to keep interest rates high, that can put the brakes on those profits, and so that's what we're looking for. So just a quick one today. Thanks for tuning in. Apologies that it was running a little bit late. We'll be back again next week, so at 12:30 every Thursday. Pop any questions into YouTube, or you can sign up on our website. We're on most of the major podcast platforms, and look forward to seeing you all again next week. Thank you.